So this is a final lecture in Chapter 7. It's actually going to be a very short lecture. There's only 3 slides here, or actually 2 slides, I believe. Other stock valuation models. I did mention that in the problems I work an example using PE ratios. So the higher the PE ratio, the more investors are willing to pay for each dollar earned by the firm. High PE stocks are typically considered more speculative stocks. Think of companies like Amazon and Google. Those don't know where their PE ratios are now since the market movement, since the decline in the market, but PE ratios of 60, 70, even 80 for companies like that that are not uncommon. Even as successful as Amazon is, the value of that company is still very, very speculative. It's based on expected returns at some point in the future. So just something to think about if you're investing in stocks like that. The PE ratio gives an indication of the stock's payback period. Just to take a step back here. P is the price per share, and E is the earnings per share. So P divided by E, market price per share of the common stock divided by the earnings per share. If you're looking on on a website, the PE ratio can be a forward-looking or backward-looking, so it can be based on expected earnings per share, but it can also be based on current earnings per share. But need to pay attention if you're looking at that. The other stock valuation models, very common is the economic value added approach. So this formula would actually give you a market, something akin to a market capitalization or the total value of all stock. So take the earnings before interest and taxes, the EBIT. We multiply that by 1 minus the tax rate, and then they subtract the average cost of funds multiplied by invested capital. If we were to calculate a value of the stock, we would need to divide this by the number of shares outstanding. Then finally, changes in stock prices. So prices move opposite to changes in rates of return. So if investors require higher rates of return, the prices are going to fall. Lower rates of return, the prices are going to rise. So if you look at what's been going on in the markets recently, investors are requiring higher rates of return to invest in stocks that are considered to be risky or that may be affected by what's going on in the world. Prices move in the same direction as changes in cash flows. If cash flows are expected to increase in the future, like for example an Amazon or a Google or some firm of that type, the expectations are that the cash flows are continued to grow. That increases the value of the stock. So, all right, that is the end of Chapter 7.